Yeah, hi, good morning to all of you. Thanks a lot for joining and welcome to all of you in ET Talks number 21. Today we have Mr. Simal Kanuga, who stays in D Tower. He will talk about mutual fund investing. So I'll introduce a bit about Simal. Simal is a very senior functionary in HDFC Asset Management company, basically HDFC Mutual Fund. And he has been with that firm since almost now 18 odd years. Prior to this, he has worked in Citibank and another mutual fund called Zurich Mutual Fund. In HDFC Asset Management, he functions across various roles. He is head of the new products and initiatives there, and also looks after investor relations, marketing of portfolio management services, and also co-heads the international business. He's part of the core team, which is also working on the VCPE fund of funds for HDFC Mutual Fund. So with this, I'll hand over to Simal to take over, to take the session and start his presentation. Simal.
Yes, thanks, Anil, and thanks everyone. So thank you, Anil, very much for getting me here, and I think special thanks to Mr. Purwar for pushing me to do this. I know.
Yeah, actually, let me take a moment to thank Mr. Purwar. It was because of his efforts that this talk is happening. So thank you, Mr. Purwar.
So actually, I think mutual fund investing, this is a very wide topic, and so I'm just taking the liberty of speaking on whether one should invest through mutual funds or direct. Of course, there is no one-line answer, but I'll try and present some data which hopefully should take you a step further out in your decision-making process. Now, what is owning equities? And I'm starting with equities. I'll come to fixed income later. What is owning equities all about? It is nothing, but it is basically owning a business. So say, for example, you're owning shares of Tata Group. You are actually benefiting from the skill set, right from Mr. Chandra to hundreds and hundreds of professionals who work out there. But yes, I think before you buy this share, you need to have some bit of understanding of the business they are into, or even for that matter, company, a particular business that you're buying into, some level of understanding of the sector that you are investing in. I think people feel that if I read a couple of news clippings, that answers my question. Not necessarily. I think reading the balance sheet would be just the start, right? So if you have time to research, understand, and competence to kind of evaluate a business, direct equity investing is definitely for you. But if you ask me, it just doesn't stop here. It also further needs patience and the stomach to bear the ups and downs of the market. In my about 25 years, I have seen this cycle, and this cycle, as we call it, of fear, greed, and hope. At the lower end of the market, fear dominates. Upper end of the market, greed dominates. Someone wise has made this comment, and I'm sure a lot of you are aware of. Equities are a funny asset class. People like buying when the prices go up, and vice versa. So against common sense, but yes, that's the way it is. Now, the problem or the challenge that I have seen, right? What tends to happen is when the news flows are negative, right? Like today, for example, or say maybe a couple of months back, when the Ukraine war started, a lot of people started exiting equities. Or 2 years before, let's look at say Jan, Feb or March of 2020, when COVID really hit, we exactly saw the same challenge. And believe you me, this fear, greed, and hope, right? This is not something that only you and me live through. Even the wisest in the world, right? If you look at, say, I've taken an extreme example, and I'm going to take some extreme examples, so you please excuse me for that. Look at what happened to Sir Isaac Newton, the man with one of the highest IQ ever. He bought a stock of a company called South Sea, very early days, made money, exited, and then his friends bought, made more money, and that got him again to buy the same share. Not many are aware, but Sir Newton actually went broke when the stock crashed. Right. So I think, and after this, if I'm not mistaken, I think Mr. Buffett had made a very interesting comment stating that equity investing is not only about IQ, it's about EQ. Emotions tend to overrule, and one needs to be a bit careful about that. Now, this is something that will give you a very interesting data point. Indians finally have woken up to equity investing, which is definitely very good news. From say 2 crore demat accounts in March of 2012, we can see that number went to 28 in March of 17 and 32 odd crores in March of 18. So if you look at, it went up by say close to what 60 odd percent in 6 years. Last 4 years, we have added another nearly 6 crore accounts, of which 4 crore has come in just in last 12 months. I don't necessarily have data on this, but if I have to kind of make a guess, to me, it feels that most of these are for trading in stocks. Zerodha, I'm sure a lot of you have heard about Zerodha. It is amongst the largest brokers in India. Their founder, Nitin Kamath, made a comment saying that less than 1% of active traders at Zerodha earn more money than bank fixed deposits over a 3-year period. Now, this is startling data, right? I would have not guessed this. Equity trading these days, actually, unfortunately, is now becoming more of entertainment. I remember, and I think I should have put that quote here. Zerodha founder also commented that 80% of all open buy option positions, people who trade in options derivatives, at the end of every day are in losses. He actually also said that it is actually ruining retail traders, right? Nowadays, like I meet a lot of say my cousins' kids, my colleagues' kids, and when I talk to them, they talk of 4 mobile apps or something in same line, right? They say that I like Dream 11 or My 11 Circle, whatever, to kind of bet on cricket matches or other sports. They further go out and have an app like a Coinbase or whatever it is called for trading in Bitcoins or other digital currencies. They actually then have a Fortnite or one of those apps. And then they also do have a Zerodha or a Grow or a Upstock to trade in stocks, right? So I think if I might say, people have started speculating at different levels, taking the liberty of using the word even gambling out here. So I think things are getting stretched out of proportion. And in my career, this is not for the first time I'm seeing this. I've seen this in past, and I'm very confident that I'll see it a number of times in days to come also. Now, I think maybe I should repeat the quote that I've put in at the bottom of this slide. It says, it is again by Mr. Warren Buffett. He says that the market, like the Lord, does help those who help themselves. But unlike the Lord, the market does not forgive those who know not what they do. So once you lose money, I think we all have ourselves to blame. My humble submission, try and focus on not losing money. The rest will follow. Now, how have individuals, investors, or IPOs fared over the last many years, right? Came across in Hyderabad, what they have found, and they kind of looked at, and this is the data they crunched in conjunction with the National Stock Exchange. They looked at individual retail investors. I think they looked at over 20 lakh investors. Now, they consistently in this survey stated chase 0 rate of return on their stock investments when they obviously make decisions themselves. 80% out of these 20 lakh people, and this is basically verified by data, have lost money in markets. Now that is startling, right? So the chance of me being in 80 is higher than in 20. And the reason behind that being nothing else but excess bit of confidence. People tend to kind of sell stocks early. I don't know many investors who have held on to their winners for very long, right? So for example, people who bought a Kotak Bank, HDFC Bank, Bajaj Finance very early, they made some money and sold on. But if you look at some of the other shares where they're losing money, they will keep kind of holding on to it. It is very commonsensical. People don't like to book losses. And I think the last of the leg is people don't kind of seek professional advice. When it comes to health, we don't take our medicines on our own. We do rush to the doctors. I suggest the same should be done even with investments. Actually, maybe this data at the bottom of this slide also very interesting. There have been around some 544 stocks that have got listed as IPOs in the last 10 years. I pulled this data out of one of the public websites. I think it was on ET or something. Look at what is happening there. 338 out of 544 have stopped trading. Another 100 are quoting well below their IPO price. So basically 448 out of 544. So what is that? That's nearly 80% is where people have lost money. Yet for every new IPO, they are attracted to putting more money in. Now, this is the question that I'm asked most frequently, and I'm talking about my friends, my relatives, everybody. Should I directly buy stocks? Should I basically invest in mutual funds? Irrespective of answer I give, they do what they like. So over a period of time, and I think my wife does tell me many a times that you kind of started ignoring questions. I don't tend to ignore those. I just know that my answer has a limited validity or anything. So why waste energy? But if you look at what has happened, right? Let us look at, say, the top 100 companies. The minimum returns in last 5 years is 11% per annum. Maximum has been 98. Believe me, the stock with 98% return has seen minimal retail participation. So just why not buy something that is professionally managed like a mutual fund, right? So that is what my submission here would be, and more data to follow. See, this is the example I love to give. Your 20 rupees to become 100, you need to see an appreciation of 400%. But your 100 to come back to 20, you need to lose only 80%. So as far as you don't lose money in equities, rest assured you will make a lot of money. Let us clearly focus on no permanent loss of capital. Volatility, ups and downs of markets, part of the game, but do avoid big losses. I've seen extremely skewed portfolios in my career. One company delivers large returns, it becomes 80% of the portfolio. I do see this with a lot of people with stock options. Even in my own company, I think people have disproportionate allocation to the own stock because that they have kind of gained through their stock option. I think diversification is key to wealth creation. And diversification doesn't mean that you need to have 20, 30, or 40 companies. Even 40 stock portfolios can be termed as non-diversified because they might have excess correlation. I'm sorry to use that jargon, but what I mean is 2 different companies in the portfolio should have fortunes linked to different dynamics. And that is actually diversification. So even a 10 stock portfolio might have a higher level of diversification versus a 30 stock. A single stock weightage, depending on how your risk profile is, should be well in balance. Now, what has happened over our lifespan is that the company lifespans are getting shorter and shorter. Not easy for forget only an average investor, but even a professional investor to get this right. So all of us do give success examples, say in banking, for like if I have to kind of pull out 2, 3, 4 names, we all talk of HDFC Bank or Kotak Bank. But how many of us do remember the banks that were launched in similar era, which just went down under, right? Let us take names like, say, a Global Trust Bank or a Times Bank. They don't exist anymore. Now, I can give you examples. I do remember very early days of my career. I met a gentleman who kind of gave me an update of his meeting at Kodak. He stated that the management is very confident that the digital photography will go nowhere. They stated that they will set up hundreds of stores where photos will be printed in 10 minutes, 20 minutes. I'm sure a lot of us do remember that 1-hour Photoshops. The rest we know is the way it is. Actually, now mobile phones have disrupted cameras. So I think it is fairly important to kind of keep an eye on the ball. At the same point of time, equally important to actually separate noise from information, right? So like if I look at last year, I think people had written off oil. They said green energy is the way to be. I remember reading reports at where oil was at, say, $50, $60, $70, that oil will kind of get back to single digits. Now the same set of people are writing reports that the oil will go to $200. So let's not write by extremes. I'm not saying that it is impossible or possible for anybody to forecast, but to take a balance is not very easy, especially for people like you and me. Now, mutual funds, so I've been working with virtually the same. So I think Anil did introduce. I started my career in Zurich Mutual Fund for 6 years. At the end of 2000, somewhere in 2003, Zurich got sold to HDFC. I wasn't lucky enough to get a job at HDFC then. So for a year in between, I worked with Citi and rejoined HDFC in 2004. So I've sold or been associated with the same fund since 1997, since I kind of qualified. So I'm sorry for this, but I'm just taking the liberty of showing one of our funds for comparative reasons. The reason I've selected this fund is it has the longest history. It's been around since 1995. Everything that can go wrong has gone wrong in this 27 years. The fund yet has done 19% per annum compounded over 27 years. Now, look at what has happened in this 27 years. We saw the Ketan Parekh scam to global financial crisis in 2008. We did see the GSTs coming in, demonetization, COVID-19, and of late the Russian or the Ukrainian war, as we call it. Yet the fund has survived. Some of the companies have also survived, but some have not. Look at what has happened in case of, say, I'm again taking an extreme example, so not the right comparison, but just to kind of zoom things in. If you look at Panta Media Graphics, I remember this was a favorite in year 99. Means it was difficult to not own that share in a mutual fund portfolio. The share went up from 80 odd rupees to 1500. And the data does suggest that most people bought it once it went to 7, 8 or 900 rupees, not pre that. Year down the line, the share was trading at 30 rupees odd. So again, a permanent loss of capital. Post that, it has now got delisted. Even let's look at a share like Hindustan Lever, right? It is like a favorite, but a fund has outperformed Hindustan Lever. Of course, there are HDFCs and there are Kotak banks and Bajaj Finances which have done better. But if you have a neck or the skill to identify those, great. If not, mutual fund does serve the purpose. Now, MFs definitely tend to be much more diversified, right? As compared to any of the portfolios I see. I know I'm generalizing, but most of the portfolios I see are not rebalanced, right? And now look at the data here. An investor who has invested in a diversified equity fund has never lost money, right? In a 10-year period. So actually he's made minimal returns of 7% per annum compounded and well above. In a 15-year, numbers look even better, 20 years, even more healthier. Even look at 5-year period. 1 out of 23 5-year periods that this fund has been around for, you would have lost money, but otherwise you would have made money across cycles. Again, let me add the disclaimer here. I'm not stating you should buy this fund. Do consult the person who you think is right, your right advisor, or do research on your own, and you can look at varied funds. So this is not the only one. I'm just taking example of this fund. There are various funds from various asset managers which will kind of give you a similar kind of statistical data. Now, this slide, I think, has data on 2 popular stocks. I've taken Reliance Industries. I'm sorry, I think this jumped. Okay, so this slide has data on 2 popular stocks, Reliance Industries, and sometimes technology plays with you. Just give me 1 sec. I hope it stays. Yeah. So this slide has data on 2 popular stocks, Reliance Industries and Hindustan Unilever. Let's talk of Reliance, right? It made no returns from 2009 to 2017, I think. Yeah, 17. And kind of, if you look at it, profits during that time period did pretty well. So as a person who has researched that stock, you'd be pretty okay saying that, okay, profits are doing well. But now look at the top chart on the extreme right. It basically tells you about number of shareholders that Reliance had, right? And that gives you an amazing data. If you see, when the share did not do anything, number of shareholders came down from 35 odd lakhs to 20 odd lakhs. As the share started going up, number of shareholders started rising. Again, just relating to what I stated earlier. People tend to buy stocks when prices go up. Counterintuitive. An Amazon sale attracts 10x the sales. So anything available relatively cheap, people want to buy more. Equities, for whatever reason, it is the other way around. Similar is the data in case of, say, Hindustan Unilever. It is even more startling. Look at what has happened. For the stock had gave 0 returns between 2000 to 2009. 9 years, 0 returns. Great company, great business, I don't think so anybody has doubt on this business. Post that, the stock went up from 600 odd rupees to 2000 odd rupees. And look at the number of shareholders. More people bought this stock after it went well above the 1500 or 1800 mark, and just tells you what happened. Actually, I should have, if you look at the dip in the data, so basically the share went up to, if I'm not mistaken, some 28, 2900 or even 3000, fell back to 22 or 100 rupees now. And number of shareholders who bought it well above 2200 would be large. Maybe 50% of shareholders are today in losses in share of Hindustan Unilever. So great business, great company, but it won't reward everybody and anybody. That's what I'm trying to point out. Even for two of the other names like and Kotak Bank. Now this is interesting. Different sectors tend to perform at different times, right? This is yearly data. And that could be for varied reasons, right? I'm not stating that it is not the right thing, but most of the times I have seen that the number of shareholders, like what I showed in the previous slide, will well correlate with this. So you will see, for example, number of shareholders in metal companies now rising, or for that matter, it would have risen in year 2020 in the FMCG companies. So people tend to buy after seeing price action right before times. So here, let me again add a line of caution. My view definitely might be biased. You may want to not take it only with a pinch of salt, maybe just take it with a feast of salt. I personally feel that for most of us, mutual fund is far better an option than it comes to direct equity investing. Offers you diversification, access to professional management, very tightly regulated, and same time does offer you better tax efficiency. Even legends have said so, right? If you look at Vanita Wenskapel, one of the famous authors, she clearly mentioned that it is much more logical thing to do. The great Peter Lynch stated the same, that if people do not have the skill set, wherewithal, time, energy, everything to own stocks and do research, equity mutual funds is basically the best available option. Now, let me spend a minute or two on benefits of investing for the long term, right? If you look at the annual returns, this is nothing else but the Nifty 50 returns for every financial year. I got in data ready from since 99, so I put in 99 to 2022. If you look at this, returns have been all over the place, right? You've seen negative 25% return and you've seen positive 80% return. So you've seen everything, or even a negative 30s. Now, if you look at the chart at the bottom, that data is available for a longer period, say 40 odd years. Equities have delivered 15 odd percent, which is twice the return of gold or twice the return nearly of bank deposits. There is a price to pay, and that is in form of volatility. You will keep going, your portfolios will keep going up and down. You'll have to live with that. But as far as you're willing to live with that, your returns can be anywhere between 1.5 to 2x of other asset classes. This is the slide I really love. In our practical life, right, it is very easy for us all to know what we are going to do today. So you're going to go out for lunch today, dinner tonight, or meeting some friends, or whatever is the case. I'm sure it's very difficult for any of us to guess what we would be doing, say, on a Sunday 5 years out, apart from listening to Anil and his wonderful session. So outside of that, to talk of what we will be doing 5 years out is very difficult. Equity is actually the other way around, where it is easy to kind of forecast what will happen 5 years out, very difficult to forecast what will happen tomorrow, day after, or on a week down the line. Somebody has stated that the only day I know what the market would do would be on Saturday and Sundays. Those are the days when the markets are closed. Nowadays, I think we don't even have that luxury with the futures and some other form of trading that have got kind of discovered, invented, whatever we might want to say. Now, let us look at the data here. This is nothing. This is purely Sensex data as of 31st March every year. And we have taken data dates back to March of 1979. If you are an investor for a 1 year period, 31st March you invest, following 31st March you exit, your return range could have been as high as 260 odd percent to worst case minus 45%, right? You've seen that whole thing. Now 45% negative is what? 100 becomes nearly 50. So for you to go back to where you were, you will need to appreciate by 100%, right? Which is easier said than done. If you look at the data for a 5-year period, there have really small, but 39 odd data points. Of that, you would have made money in 36 out of those 39 times. If you look at a 10-year period, you would have kind of virtually made money every 10-year period. So you invest in March of 2001, wait till March of 2011, the chance of you losing money is 1 out of 34. So virtually nothing. And even that 1 out of 34 will become 0 if I add back dividends. If you add dividends to this, which is around 2%, you would have never lost money as far as your stayed put for a 10-year period. For a 15 and 20-year data clearly, people do say that who does wait for 10 years, but that's the price that we pay, right? So I think a lot of people know the very fact that if you eat an ice cream, it's calories which kind of gets in along with whatever pleasure we get on our tongue. So equity, I think like calories to ice cream, equity, volatility is to equities. If you are willing to ignore that or work around that, the opportunity is clearly there. Now this is startling, right? People try to trade, be it inflation, be it a Ukraine war challenge. People want to move out, move in. We have taken this data again for last, say, 32 odd years. It has been 7,782 working days in the market. If you would have just stayed put, you would have made nearly 13-14% kind of return compounded annually. However, let's assume that you try to time the ups and downs of the market, right? You try and exit, enter. Look at what you miss out on. For whatever reason, you are out of the market for 10 days out of the 7,782 days. Your 13% would come down to 10. If you are out for 40 best days, out of those 7,782 days, your returns would have been in line with maybe lower than bank deposit, maybe in line with the savings bank account rate, right? You come down from 14% to 4% or 13% to 4.5%. If you just miss 40 days out of 7,782. So the price you pay of trying to zig when the market zags generally tends to hurt you rather than anything else. There are people who feel otherwise, but the data, and finally, as somebody stated, right, let's believe in God, and for everything else, let's just rely on numbers. So I think I would take that as a perspective here. I'm sorry, for whatever reason, it's just taking a second extra to go. That's a weird thing. I'm sorry for this, but
this page down on keyboard not working, Simal, if the cursor is not working.
I've tried doing it, but I think it's just rolling out. So maybe what I can do is I'll just let me see if I just opening on another screen to see if that's any better. This is weird. Okay, so maybe I'll talk till this loads or whatever. I think the following slide actually, even without the slide, we can get the data here. Okay, so your following slide, I've kind of just presented the fund that I referred to. HDFC is a flexi cap fund. Again, a track record of 25, 27 years. Just taking that fund because it's again a longest history. 10 rupees in 95 has become 1,000 rupees today. That's the power of that 19%, right? So, and in this 20 years odd, as I stated, we have seen everything that is possible. Should I just re-log in because it's some. maybe what I can, if you give me a minute, Anil, I'll just re-log in a
Yeah,
second.
sure. Try. I think.
Yeah.
Just wait for a minute. Sure. Thank you all.
Is it visible now?
Yes.
Okay, great. So I think a couple of slides that I missed, maybe I'll just quickly, I think it's for whatever reason just getting hung. Weird, no? Stop share. Let me. This is one. Just okay, I'm sorry for that, but I'm not able to figure out what the problem is. It is somehow, unless I log in from another PC or something. So maybe I think that's fine. I can always talk. So let me talk further out here, right? And so if I was just talking about some of the equities and how equities have delivered over long periods of time, I'm just taking my iPad on the side to see what data I had here. So yeah, I think equities for long-term mutual funds may be an ideal option for one to actually capture what markets does is the essence that I was trying to get to. I think maybe even Zoom likes equities more. So when I was about to switch to fixed income, that's where it kind of gave up. So let me go further out and talk about mutual funds in the last few minutes that I have. Debt mutual funds is what I mean. Now, I don't know about whether you are aware, right, how Indians invest their money. The Indian households save anywhere between $500 to $600 billion every year, right? People like you and me, right? We save $500 to $600 billion. So we are talking about what? Nearly 40 to 50 lakh crores of rupees every year gets saved by Indian households. What do we do with that money? 50% of that money, as per RBI statistics, go into bank deposits. Sorry, go into physical assets. 50% goes into real estate and gold. The other 50% goes into financial assets. Of the other 50%, which is like 20-25 lakh crores of rupees, of that, half of it nearly goes into bank deposits, right? And so that leaves another half for everything else. And everything else, I mean equities, mutual funds, post office, senior citizen savings plan, or for that matter, even life insurance policies, everything else. Everything else is half of the financial assets. So repeating numbers, 40 to 50 lakh crores is what we save, half of it in physical assets. Of the balance, half goes into fixed deposits. What goes into equities, equity mutual funds, capital markets is hardly 5-7%. Now, this is the asset class which has delivered the maximum return over longest period of time, but is something that we Indians haven't capitalized on. Good luck, good news, things are changing. Indians are adapting to equities clearly more and more as time is going by. Now, but yes, fixed income, very much part of the portfolios. People have to kind of abide by their asset allocation. Let us look at the way to buy into fixed income. I think the best option, in my opinion, again, you can take it with a feast of salt or beans and bags of salt as compared to pinch of salt, is mutual funds, and forget everything else. And I'll come to everything else in a minute. Just because of the tax efficiency it does provide, right? So if you kind of get a 7% return in a bank deposit versus 5% in a mutual fund, for a taxpayer in the highest tax paying bracket, he's better off still investing in a mutual fund, right? Just because of the tax efficiency. On an interest income, you pay 30% plus the surcharge applicable goes to as high as 40 odd percent. As against that, the capital gain is 20 odd percent plus surcharge, of course, but you get the benefit of indexation. Now, that is one big benefit of investing in debt mutual fund. Apart from this, obviously, there is a benefit of diversification. We all know, right? We have number of cooperative banks which have had their own set of challenges. We have seen number of individual companies. So fortunately, over a period of time, the default rates have come down from individual fixed deposits, but it is still there. So like I was telling this to somebody, and he said that please walk out of Nariman Point, Lower Parel, and BKC. Default rates today are also very high. So mutual funds does offer you a very effective diversification, long portfolios. You have to be cautious on what you buy. I know there have been instances where mutual funds have let you down, but mutual funds offer you varied levels of risk. As far as you are able to get that in consultation with your advisor or with your own research, you will be able to, in the most of the instances, be better off than buying into deposits. I think inflation is a killer. So please do focus on that. Higher inflation takes a large part of your gains away. And that is something which is definitely very, very relevant when you are investing in fixed income. Inflation and tax is something that is well beyond your and my control. So if we can optimize on those two counts, we'll definitely be better off. So yeah, that's what all I wanted to state. Maybe I can end with a small anecdote which I tend to repeat in every presentation I make. People in my fraternity, and I think a lot of them are there in our building, do get asked one question more often than not, and that is, market kya lagta hai? Believe you me, we know as much as you do. And let me try and give you this wide an example. So there was a 4-year-old kid scribbling something on a piece of paper. The mother was a bit curious, went up to her and said that, what are you up to? She says, I'm writing a letter to my 2-year-old brother. So the mom says, what? But you don't know how to write. She says, he doesn't know how to read, right? That's the beauty of our profession. People do ask us, market kya lagta hai? We give you some story, neither we know, neither you know. So let us not even try and bother ourselves with trying to understand the direction of the market, direction of the economy around. I think Mr. Buffett has stated very, very smartly. He says that I don't know many economists who are really rich, right? That just tells you again the story around it. So yes, thank you so very much for giving your time on a Sunday morning. I reside in Tower D for Delhi, 1501. If you need any assistance anytime, just feel free to call on me. Happy to help in whichever way I can. So thank you once again, and really appreciate your patient hearing. Any questions? Happy to take them.
So that was a very insightful presentation and discussion, Simal. Thanks a lot. So any audience, anybody wants to ask any questions?
Simal, I would like you to sort of throw some light on investment by SIP,
right,
and otherwise. I think that is one thing which is emerging very important. So can you please speak on this aspect?
No, sure, sir. So I think, see, SIPs are a very powerful tool on 2 or 3 different counts, right? One is a very powerful tool for a regular saver. So people like me who have like monthly income landing into my savings account. That is, and actually okay, so SIP is a new age term. New age, I mean last few years. I remember the first presentation that we had made as a company. We made a statement stating that we are a secular company, but SIPs are religion, right? So we've been trying to advocate SIP right from our early days. It has caught a lot of attention in recent past, but Indians have been aligned to doing this for ages. If you recall, in say 10, 20, 30 years back, we all used to believe in something called recurring deposit, where every month we were investing in a bank deposit. RDs were a very, very popular option. SIPs have replaced that partially, not fully, but partially. So SIPs, one is great savings habit, aligns well with your income. Also, it tends to kind of take away the volatility in the market. So if you invest 1,000 rupees every month, look at this power, okay? If you invest 1,000 rupees today at an NAV of 10, if you invest 1,000 rupees, say 1 year down the line, markets are down 50% at an NAV of 5. The average is not 7.5. 10 and 5 divided by 2, you would take it as 7.5. But you have invested the same amount of money at 1,000, same amount at the NAV of 10, same amount at an NAV of 5. The average will come to 6.66, which is lower than 7.5, right? We tend to buy same number of quantity, but here at a lower price, you will buy more units, and that actually reduces the average price. So if you look at the SIPs over a long period of time, have delivered very, very healthy returns. And actually the beauty of SIP is it tends to ride over your emotions when times are bad, right? So in March of 2020, when the markets were down, whatever, 20, 30%, you're still investing. Logically, people would have stopped investing if they were investing one time. They would have said that, let me just wait for a better time. Markets are going to correct. Newspapers are saying so. Now, please don't rely on these newspapers, right? Because one of my investor tells me that without any disrespect to the newspapers, they said that it costs ₹2, give it that much worth, right? So on the lighter side. But what we are trying to state here is that let us not get carried away by emotions. And the way to beat that, the cycle of fear, greed, and hope that I did showcase, the way to beat that is basically by doing nothing but investing regularly. So over long periods of time, SIPs have created enormous amount of wealth. And good news is, I think the Indian investing community has woken up to that. So few years back, it used to be 1,000 crores a month. Last month, it was some 12,000 plus crores every month. This is huge now. So this has happened in 1970s in US, right? They call it the 401k movement of US, where there were some special tax advantages given. Indians have gone a step further out. We have started investing even without talking of tax advantages. So I think commendable so-called cultural change. And as time goes by, in short term, we'll do see gyrations. I'm not saying that it's going to be straight line, but as far as you have so-called capability of taking the strides up and down, you are definitely better off.
Can I ask, Anil?
Yeah, Shuni, yeah, please go ahead.
Thank you very much, Simal, for a wonderful presentation on investing. What is your advice for senior citizens who don't have a regular income or a regular professional income, only through their savings? So any specific investment suggestion for senior citizens, retired senior citizens?
Sure, sir. So I think, sir, the best way for a senior citizen is you need to make it sure that your income is well aligned with your expenses. So as far as whatever you need on your monthly basis, plus slightly more, should basically be kept in something which is utmost safe, right? To take care of even future inflationary challenges. So if, for example, you need a monthly income of 1 lakh rupees, let's be prepared for a slightly higher number. In terms of specific advice on where that investment should be, you can start off with something which is administered rates wide, the senior citizen plan of Government of India, to some of the other bonds available, which are absolutely low on risk. You can even look at debt mutual funds with something called automatic withdrawal plan, whereby that is a very tax efficient way of investing. And a large part of your gains will kind of get converted into capital gains. So that is another option. Whatever portion of money, and maybe this is applicable to each one of us, not only to people who are retired, is basically whatever pot of money you don't need for a minimal period of 5 years, where you are willing to digest volatility. And by digest, I don't mean only financially, but also emotionally. See, most of people living in our community are the ones who can digest volatility financially, but many could not do it emotionally. So as far as you are able to do that, that portion of money can go into equities. But sir, to specific question of yours, at least to your regular income plus slightly more should be kept into fixed income alternatives, be it mutual funds or otherwise, and balance it in the right way.
Thank you. Thank you, Simal.
Pleasure, sir.
Ashwini, your raised hand. You want to go ahead?
Thanks, Anil. Thanks, Simal, for this wonderful presentation. And my question, not just the question, maybe thought, is something in continuity with what Vinodji just mentioned. People generally, as you also said, corroborated with the help of the data, don't go for the equity market because maybe they are more worried about the volatility on that. In the longer run, I know it's going to be good, better than the bank deposit, better than any other investment mode. But suddenly when I need the money at that point of time, if it is going through a bad phase, that becomes really challenging and really hurtful. Now, it's something, again, as I said, what Vinodji mentioned, what should be the strategy? For the longer term, you mentioned 5 years and more, I can live with the volatility emotionally, financially. But when I get closer to some big need, when I know that maybe next 1 year, 2 year, I'll be needing part of my portfolio to be uncashed, need to do, what should be the strategy for that? What kind of shift one should do away from equity and debt also? I'm not sure. Current, the way rates are moving, even debt sometimes can be, you go through a bad patch. But what should be the strategy and what should be the time frame one should look at? How one can rebalance the portfolio when you get closer to some big ticket expenses?
No, I think, sir, very valid. And let me kind of take this question in two parts. So let's start with equity part of your question. Assume that a big expense is coming in next year or two, you should actually exit to the extent required, pull money out of equities without thinking twice. I think irrespective of where the markets are, because markets 12 months down the line can be worse off from where they are today. So there are two ways to do this, sir. One is basically realign your portfolio on periodic basis in lines with your preferred asset allocation. So if you think that I'm okay with 60% equities, 40% debt, try and do this once every year, once every 2 years, 3 years, or whenever there is a huge change in the way the asset allocation is, right? So let's assume that I start today with 60-40. For whatever reason, 1 year down the line, markets are up 50%. So my 60 becomes 90, while 40 would have become, say, 45, or not even 45, 42 or 43. So it becomes now 90 and 40. Now, when it is at 90 and 40, I need to tell myself that now I've gone to 70% in equity, right? From a number which I initially planned for. So I kind of rebalance myself and go back to what kind of gives me comfort. So that is one way of doing this. Second way of doing it is basically, if you know that an expense is coming up 1 year, 2 years down the line, to the extent of money required, take money of equities and invest into fixed income. Now, when you look at fixed income, and just specifically answering what you mentioned about interest rates moving up and down, when we talk of fixed income, what you should definitely do is, again, try and align that with the need of your capital. So for example, you are clear, right? I've taken money out of equity, 1.5 years down the line, I might need this money. Please do not invest in a long-term debt fund, whatever the rate expectations are. If expectations are the rates going down, yet you should not look at a long-term bond fund. Try and keep your investments aligned to the maturity profile of the fund, right? So basically, you know that 1.5 year down the line, I need to do that. Please go ahead and do it. Now, also the fact, let's assume that I have some money today. My asset allocation idea is a 50-50. So for 15 equities, to do it, I invest either today or I spread investments over the next 3 months, 6 months. So depending on what gives you comfort, please do that. On the fixed income side, don't try and second guess the market, right? So let's not try and understand where rates are going up or down. What we can instead do is that let us kind of invest what we think is, say, for example, today a 7-year long-term bond fund would be trading at a YTM or a yield of, say, 7 or 7.5%. So am I happy with those kind of returns over long term? If the answer is yes, you can invest that today, stay invested for a longer term, and your returns would be more or less in lines with that, irrespective of the interest rate volatility. See, interest rates will come up, go down. I think that is part of cycle. 2 years back, the entire of the Western world was fraught with the idea of zero interest rates. And for the first time in my career, I also heard terminologies like negative interest rates, right? You were to pay money for investing your money. And from there on, now people are at the other extreme, expecting interest rates to go up. So let's not even try and second guess. But yes, if there is a worry that, okay, interest rates, I'm not comfortable with this, I'll try and tend to stay at the shorter end of the yield curve, you can do so. So obviously, personal profiles, here it is very difficult for me to tell you what one individual should do, but what I can tell you in a generalized form is what I mentioned. But in terms of your individual portfolios, I think the best thing to do is take professional advice or really deep dive into it and figure out what works best for you. I hope I've been able to answer your question.
Yes, yes. Thanks, Simal.
Sir, I'm Anuradha Thakur. Can you hear me, please?
Yes, ma'am. Very well, ma'am.
Yeah. Sir, I have been associated with mutual fund industry for last 4 years, but I still don't get a feeling that I understand it.
Okay.
Because I think it is one of the most complicated and most regulated industries. Now, my specific question is that, of course, I also go by what the newspapers say, but the ET, there were some articles a few days back that this is the right time to go for international funds. Of course, the index funds related to NASDAQ or S&P, whatever it is. And because there is also the market average the rock bottom. But when I talk to the person who gives me advice, he said, don't even think of it. Whoever has put money in that, my clients, they have lost money. So what is your advice on that? Of course, the rupee volatility is one great factor now. But since RBI has relaxed some restrictions, I would like to know your views, sir.
Sure. So thank you, ma'am. And I think we finance professionals are to be blamed for making this simple investment vehicle so complex. So apologies on behalf of my community, but I think so. The international funds, see NASDAQ. I don't necessarily agree that people have only lost money in a 10-year period. People who invested in 2011 and 2012 have made a lot of money by investing in NASDAQ. But NASDAQ is not diversification. So if you are looking at something that, so NASDAQ is predominantly technology or its ancillaries. If that is something that you want to invest a small part of your total wealth in, you can go ahead and invest. In terms of investing in the S&P 500 or any other broad-based diversified offerings, I think the same logic stands true that I mentioned for equity investing. If you are investing for 5-10 years, I don't think so you will have many reasons to complain. Have markets globally corrected? Answer is yes. But neither you or me can time that to perfection. Unfortunately, in terms of international investing, as you rightly pointed out, these limits have just got opened. It might again close. So you may not have the luxury of investing at your will and wish. But most of the mutual fund companies have kept their SIPs on those products. So you might want to just invest regularly to tide over volatility. Rupee depreciating actually helps international funds. So it is a great hedge against rupee depreciation. And also you get access to global markets, right? We are using Zoom as of now, and the beneficiary of Zoom is basically company listed in US. So if you are looking at benefiting from global diversification, accessing global markets, those funds are very good. Don't get battered by what has happened in last 2 or 3 years. And actually, funnily, ma'am, most money, the NASDAQ fund, the oldest NASDAQ fund listed in India, which I think is the Motilal Oswal fund, was brought up in year 2011 or 12, if I'm not wrong, if my memory serves me right. The corpus of that fund, say 3 or 4 years back, was only 100 odd crores. It never got in any money. After NASDAQ did exceptionally well, the 100 crore fund became some 7 or 8,000 crores. Imagine what happened. So people tend to invest after the markets or the asset class performs. What I have stated has got proven here once again. But now let us not invest because it has not done well in last 3 or 4 years. So if you think that you want to invest part of your money in high risk technology companies in US, NASDAQ is definitely a good option.
Thank you so much, sir. Thanks a lot.
Thank you, ma'am. Thank you.
Any other question? Simal, I have one question. If you just give, a little bit of an idea of current mutual fund size, industry size, how much is equity, how much is debt, how the industry has evolved last couple of years, and how do you see it going forward as well?
Sure. So the size of the mutual fund industry now is around 38 odd lakh crores. So of the 38 odd lakh crores, 18 odd lakh crores is equity oriented mutual funds. And this is basically, this would include your balance funds, which are predominantly investing into equities, and all other equity oriented funds, right from large cap, small cap, mid cap, flexi cap. As I mentioned, we have kind of made it a bit more complex than it is, but across everything in the equity category is 18 odd lakh crores. Another 4-5 lakh crores is in these ETFs. Now these ETFs obviously are a slightly different animal. A large part of that again is equity, but we have one single investor, which is the Employees Provident Fund Organization, which contributes very large part of that 4 or 5 lakh crores. And balance is everything right from your overnight fund to the long-term debt funds. So that is the big picture breakup of Indian mutual fund industry. Now look at what it has happened, right? I have actually seen mutual fund industry in a very nascent stage. Out, even my own dad told me that, are you sure? Because at that point in time, I was getting jobs in some of the banks, or I was getting job in one of the large accounting and tax firms. But I took a big leap and went ahead joining a mutual fund. You will be surprised, but like for example, the largest fund from HDFC AMC's stable, it's called HDFC Balance Advantage Fund. The size of that fund is now around 44,000 crores. When I started selling that fund in early days of my career, the corpus was 9 crores. So I've seen that over the last 20 odd years in a single fund. Now, if you look at all equity mutual funds put together, which I mentioned about 18 odd lakh crores today in equities, this was 2 lakh crores on 1st of April 2014. So 2 lakh has gone to 18 lakh in the last 8-9 years. I'm not saying that we'll see the same in the next 8-9 years, but I would not be really surprised. If you would have asked me in 2014 that can this become like 8 times, 10 times in 10 years, I would have not been very sure. But now I think the cult is changing. The way people are investing is changing. Indian investors have matured to a different extent. And I can give you a great example. Like 2 weeks back on a day when the markets fell by 2%, the number of purchase transactions at HDFC mutual fund doubled. So that is something very enlightening, right? Heartening to see that people are willing to invest more money when there is a correction in the market. So the cult is changing, structure is changing. People are inculcating better so-called discipline and the way of changing the way they are investing. So that gives me a lot of optimism. As I mentioned, Anil, right? We as a country, we save 40-50 lakh crores a year. Now, what we get into all mutual funds put together is what? 50,000, 1 lakh, 1.5 lakh crores a year, which is like just hardly, or even maybe 2 lakh crores, just hardly 2, 3, 4, 5%. If this becomes 10, 20, 30%, numbers are for themselves to see 5, 7 lakh crores in a mutual fund on an annual basis. So that can make this really, really large over a period of time. So yeah, fairly optimistic. And as I would want to repeat, take my view with a lot of bias. So yes, I'm part of this business and have a very, very favorable opinion about it.
Sure. Okay. Thanks. Anybody else? Any other question? Any discussion point you want to raise?
I think I would like to take this opportunity to thank Simal. In fact, I suggested to him, I explored it with him. I suggested he must talk to all of us. In fact, I have been with HDFC Mutual Fund maybe for the last 20 years or so. In addition to SBI Mutual Fund, and I think I have greatly benefited with the advice of Simal. So I thought in Ashok Towers, since he is living here, everyone should get benefited with the expertise which we have in this area. Thank you, Simal. Thank you very much.
Thank you, everyone. Thank you so very much. Appreciate it. Thank you.
Thank you, Mr. Purwar. Thanks for making it happen. And thanks a lot, Simal, from all of us.
Thank you very much. Thank you.
Thank you. Thank you.
I
I'm
thank
sorry
all
for the
the
technical glitch, but I'm sorry for that, but I think it was fine.
That's okay. And I thank all the participants. Thank you very much for attending. Thanks a lot.
Thank you, Anil. Thank you. Bye-bye.